Ladies and gentlemen, good day and welcome to the Capri Global Capital Limited Q1 FY26 earnings conference call hosted by Go India Advisors. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Hardik Doshi from Capri Global Capital Limited. Thank you and over to you, sir.
Good morning everyone and welcome to Q1 FY26 earnings call for Capri Global Capital Limited. This is Hardik Doshi, Head Corporate Finance and Investor Relations. As a brief disclaimer, the discussion on today's call regarding Capri Global Capital Limited's earning performance will be based on judgments derived from the declared results and information regarding business opportunities available to the company at this time. The company's performance is subject to risks, uncertainties, and assumptions that could cause results to differ materially in future. Given these uncertainties and other factors, participants on today's call may observe due caution while interpreting the results. The full disclaimer is available on slide 63 of earnings presentation, which is also available on our website. Participants are requested to take note of the same. With us today on the call, we have Mr. Rajesh Sharma, Managing Director of the company, Mr. Kishore Lodha, Chief Financial Officer, Mr. Sanjeev Srivastava, Chief Risk Officer, and Ms. Divya Sutar, Director Business Strategy. I now request our Managing Director, Mr. Rajesh Sharma, to present the opening remarks. Over to you, sir.
Thank you. Good afternoon, everyone. I hope you are all doing well. We announced our unaudited financial results for the first quarter of the financial year 2026 earlier this month on 1st August. I trust you had the opportunity to review the earning presentation, which is also available on our website. Before I move on to the financial and operation highlights, there are a couple of things I would like to specifically highlight. During the quarter, we successfully completed a qualified institutional placement, raising rupees 2,000 crores in primary equity capital. This was a landmark event for the Capri Global, marking our first QIP in over a decade. The offering received a strong and broad-based response from both domestic as well as foreign institutional investors, which we view as a powerful endorsement of our financial performance, governance standards, and long-term strategic roadmap. This capital infusion significantly strengthens our balance sheet and enhances our ability to scale operations across core lending verticals, including MSME, affordable housing, gold loan, and construction finance. Importantly, it also provides us with the additional flexibility to invest in next-generation technology, including generative AI and data science capabilities, which continue to play an instrumental role in sharpening our underwriting, risk management, and customer engagement. Beyond business expansion, this fundraise opens up new avenues to further diversify our borrowing and deepen our liability franchise. As we scale responsibly, we remain focused on improving credit access for underserved customer segments, driving greater operating efficiency, and building a resilient, well-diversified, secured portfolio. Coming to our business and earning performance during the quarter. Overall, I would say it is a good start to the year. A good quarter on volume, asset under management, OPEX, profitability, ROA and ROE. We commenced FY26 with healthy momentum across our lending businesses. As of June 30th, 2025, our consolidated AUM stood at rupees 24,754 crores, registering a year-on-year growth of about 42%. This performance was led by robust retail AUM growth, driven by a 69% year-on-year surge in gold loans and 32% Y-on-Y increase in housing loans. Co-lending AUM reached about 4,681 crores, up by 64% year-on-year and contributing 18.9% of consolidated AUM versus 17.8% in Q4 FY25, underscoring our deepening partnership with leading banks. Disbursement for the quarter grew 51% year-on-year to 8,458 crores, supported by expanding distribution reach and improved customer onboarding. Growth continues to be granular and well diversified, with number of customers surpassing 5.5 lakhs, reinforcing the strength and scalability of our retail-led model. MSME loan grew to rupees 5,477 crores, while our housing finance portfolio stood at rupees 5,490 crores, translating to robust year-on-year growth about 14% and 32% respectively. The MSME business is gaining from our calibrated rollout of small ticket size secured business loan called MicroLab, now present in over 94 locations, helping us reach emerging self-employed borrowers with lower ticket size requirement. In housing finance, we continue to see resilient borrower demand across the affordable segment, where rising urbanization, income formalization, and housing upgrades are driving demand for secured credit. Further, Pradhan Mantri Awas Yojana subsidy scheme is also fueling the growth. Our gold loan business maintained strong momentum in Q1 FY26 with AUM rising 69% year-on-year to rupees 9,105 crore rupees. The portfolio is supported by 821 specialized branches with average AUM per branch at rupees 11.1 crores. As of June 25, 737 branches are operating above the break-even of rupees 5 crore AUM per branch mark. A fully digitized loan journey, AI-enabled security system, and high customer stickiness driven by repeat borrowers of 55% to power this growth. With ongoing network expansion and the activation of co-lending partnership, gold loans remains a key growth driver of high-yield secured growth business model. Our construction finance portfolio grew 61% year-on-year to rupees 4,521 crores, now funding over 280 active residential projects with an average sanction of size of rupees 41 crore. The book remains well diversified and granular, reflecting our focus on working with mid-sized developers in metro and tier 1 cities. We continue to emphasize disciplined underwriting through rigorous due diligence and escrow-based cash flows management, ensuring a risk-first approach. Demand in the affordable and mid-income housing segment remains strong, providing a steady pipeline for scalable and prudent growth. Now I am coming to the earning performance. Let me now provide an update on our core earnings. Our yield and spreads on net advances remained healthy in the quarter at 16.9% and 7.2%. Our net interest income for Q1 FY26 reached at rupees 416 crores, marking a 38% year-on-year increase, driven by a robust growth in our loan book. We continue to strengthen our non-interest income streams in Q1 FY26, reinforcing our strategy of building a diversified and resilient earning profile. Non-interest income grew 53% year-on-year to rupees 166 crore, contributing 28.5% of net total income for the quarter, driven by strong growth in co-lending fee income and insurance distribution. Our car loan distribution business maintained its steady momentum with originations of rupees 2,651 crore in Q1 FY26, up 19% year-on-year. With a growing footprint and deep relationship across 12 partner banks and finance institutions, we have built a scalable and high-volume platform in this segment. In insurance distribution, we generated net fee income of rupees 28 crore in the quarter. With partnerships across 18 insurers and increasing penetration across our retail customer base, we expect this business to become a meaningful contributor to our overall fee income going forward. Meanwhile, co-lending income stood at rupees 73 crore, supported by rising disbursal volume with partner banks. Our branch network expanded to 1,138 locations in Q1 FY26 with a net addition of 27 branches. While our employee base remained steady at 11,546, over the past few quarters, we have seen a clear shift in operational efficiency, with our cost-to-income ratio improving meaningfully to 55% to 49% in 4Q FY25 and 65% in 1Q FY25. During the quarter, we had one-time benefit of rupees 15 crore in the operating expenses due to the reversal of provisions of account of change in the perquisite policy. Adjusted for that, our cost-to-income ratio would have been 49%. The sharp improvement reflects the benefit of our maturing branch network, rising productivity due to various AI-enabled tools, and increasing digital enablement. Pre-provision operating profit surged 115% year-on-year to rupees 312 crores during the quarter, underscoring the impact of operating leverage and disciplined execution. As our network continues to mature and technology adoption deepens, we see further headroom to drive productivity gains and sustain this trend of improving operating efficiency. We continued our strong profitability momentum in Q1 FY26, delivering a robust profit after tax of rupees 175 crore, up 131% year-on-year. This sharp growth was driven by expanding margins, operating leverage benefits, and consistent performance across all key business segments. Despite the impact of recent equity fundraise, return ratios remain healthy with ROE of 13% and ROA about 3.2% for the quarter. As regards asset quality, our credit cost for the quarter increased to rupees 81 crore in Q1 FY26 from rupees 18 crore in 4Q FY25, or 1.6% of the gross loan book, and our provision coverage ratio on stage 3 loans remained at 41%, demonstrating our prudent provisioning and conservative approach to risk management. Increase in credit cost was on account of higher ECL provision of rupees 55 crore, mainly driven by increase in stage 1 provision of rupees 24 crore, increase in stage 2 assets in MSME and housing loan for rupees 71 crore, resulting in an incremental provision of rupees 22 crore. One account in construction finance with outstanding loan of rupees 16 crore slipping into NPA, which provisions of rupees 8 crore has been created. However, there was a write-back of 7 crore provision due to recovery from the previous accounts. One-off provision on car loan receivables of rupees 11 crore rupees. Gross stage 3 assets were at 1.7%, marginally higher on a sequential basis, but improved by 48 basis year-on-year, while net stage 3 stood at 1%, down 19 basis year-on-year. Collection efficiency remains strong, reinforcing the resilience of our portfolio. We are further enhancing our risk management framework by leveraging advanced analytics and data science to sharpen customer risk profiling and improving underwriting, ensuring disciplined, sustainable growth. Following the successful completion of rupees 2,000 crore equity raise through QIP during the quarter, our balance sheet is significantly stronger, providing ample headroom to accelerate growth across businesses while maintaining financial prudence. This capital infusion has resulted in a robust standalone capital adequacy ratio of 34% for CGCL, supported by total equity of 6,438 crore, while Capri Global Housing Finance Limited closed the quarter with a healthy capital adequacy of 29%. Liquidity remains comfortable with over rupees 3,700 crore in cash and bank balances, investment and undrawn credit lines across CGC and CGHFL, giving us the agility to navigate evolving market conditions and deploy capital strategically. Borrowing stood at rupees 15,979 crore with a debt-to-equity ratio of 2.5 times. We continue to diversify our funding mix by tapping capital markets, increasing the share of NCDs and commercial papers. During the quarter, we successfully raised rupees 150 crore of NCDs at competitive rates between 9 to 9.25%. Our board has also approved a public NCD issuance of up to 1,000 crore rupees, which we plan to tap opportunistically. Additionally, the softening interest rate environment driven by reduction in repo rate and subsequent decline in MCLR is expected to further lower our cost of borrowing, supporting our profitability. Our technology investment remains foundational to our ability to scale securely and efficiently. We invested rupees 26 crore this quarter in technology, data science and systems, reflecting our belief that technology is not a one-time capex, but a continuous engine of transformation. We are focusing on leveraging generative AI in further enhancing our processes for evaluating customer profile, collateral and collections. Cybersecurity and compliance-led upgrades remain core priorities as we expand our digital footprint. I am also pleased to share that Capri Global has received a strong ESG rating of 69 from NSE Sustainability Rating Analytics, placing us ahead of the most listed NBFCs on the NSE and reflecting our robust governance practices as well as our structured approach to environmental disclosures. While we see room to further strengthen the social pillar, this rating is a strong validation of our ESG journeys and our commitment to responsible growth. Complementing our ESG progress, we continue to strengthen our brand visibility through impactful campaigns like Tarakki Ke Haath, which has significantly enhanced awareness and recall across our key markets. Backed by a 360-degree media plan spanning TV, print, digital, and branch level activation, this campaign is helping us to build not just visibility but also a deeper emotional connect with the people we serve. Now, we would like to open the session for question and answer.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Gaurav Purohit from Systematics. Please go ahead.
Hi, sir. Am I audible?
Yes, sir, you're audible.
Okay. So I have a few questions. I'll start with growth. So growth has been fairly robust in the recent quarter. And given the current momentum that we're seeing, is there a possibility that we exceed the 30% guided growth range for the next 3 years?
Thank you. I think we are going to remain on course for a 30% growth, and that we believe that is quite healthy growth. We don't think we are going to exceed that this year.
Okay. And also, sir, on growth, what is giving you comfort on growing so aggressively? I understand that you are primarily into secured businesses. And what do you think can go wrong given the current environment? Because some of your peers have started reporting some stress in MSME segment. So do you think that could in later on come result into some delinquencies, or are you seeing that sign in your portfolio right now?
So I think our confidence of 30% growth comes that we are, as you rightly said, we are in a collateralized portfolio. So we have ability to recover by various means, including disposing of the property which is mortgaged to us. Out of about 35% portfolio is the gold, which is the asset quality remains in complete control, where we can auction the gold and recover our money. As regards to other segment, we agree that MSME we have seen some slippage, more particularly from a state of Madhya Pradesh, where we are already toning down our disbursements, and cautiously we are progressing on that. However, other segment of housing finance remain very stable, where we are not seeing much challenge in the asset quality. And now Pradhan Mantri Awas Yojana credit subsidy coming in the play, where the loan to value further goes down, giving us a higher security margin. I think we are going to see the good growth in that segment. So while this quarter some more delinquency have come because of various reasons, including that first quarter is always we are seeing the rise in the delinquency, either because of seasonality or also Q4 we run a lot of campaigns and incentive programs, and one of the reasons is also that quarter is less than 90 days. So some of the slippage, because of the February is the 28th month, some of the 61-90 cases slipped on in the month of April because of those 2 days advantage in the last quarter. So combination of this. However, if you see the overall delinquency, that is still our GNP is in the range of about 1.7%, net NP is about 1%. It is very, very healthy and robust.
And sir, like the trend we've seen in the last year, do you see these slippages coming down significantly in the coming quarters?
I will say that slippages will not be as much as what we have seen. We will see that overall asset quality remain in the range we have projected. So as a company, we have given the guidance that our gross NPA will never cross 2%, and net NPA will never cross 1.2%. I think we intend to maintain within that range. Specifically to project about quarter will not be possible. It can always vary 10 basis here and there, but overall range will remain the way I said.
Fair enough, sir. Also, in one of your recent media interactions after the QIP, you had mentioned that there is a potential of a credit rating upgrade. So, any progress over there? If you can share.
About what?
Credit rating. You had mentioned in one of your media interviews that
exercise is on. We should see the result by mid of September.
Okay. And then there is a possibility of a reduction in your cost from third quarter onwards.
Yeah, I think because as far as the reduction of cost is concerned, I think for the next 12 months we'll be having a higher dependency on NCD, commercial paper, and also a lot of loans whose MCLR is going to get reset. Their MCLR have already announced the reduction by various banks. And we see the inflation have also come down, so overall interest rate scenario should look like the interest rate is going to remain softened. That effect will be seen over a period of time, next 6 months. Whenever the individual banks MCLR get reset, we'll get the advantage. Plus, our incremental borrowing are going to be at a lower level by at least 30 to 40 basis. So we'll see quarter on quarter our cost of funds will come down, and by the end of the year, I think our overall cost of the fund should be at least come down by 40 to 50 basis.
Oh, that was a sizable reduction. Okay, just one specific question on your micro lab, because you said that is helping you scale up your MSME. One of your peers has actually discontinued best disbursement in that business, and specifically in the South India market. So, any comment on that? And how your book? I understand it is a very recent venture, and the book is not yet seasoned. But any signs of stress that you're seeing there?
So I think we are also growing that book very cautiously, depending on the various feedback and observation that delinquency have risen in micro lab segment. However, we are creating a differentiation by using the technology and also data science capability, where various risk triggers are being built, and we have gone a little slow till our full stack of technology gets rolled out, which should be happen by end of September. So we are cautiously trading there, and we are confident that given our experience in the collateralized lending, we'll be quite cautious the way we do the collateralization, legal title search. Any case going bad, your ability to recover comes from the confidence, the right valuation, and the right title. So we are quite confident that we'll be doing better than the competition, that business, backed by our technology and data science capabilities.
And sir, one last relating question.
Sorry
so
to
in case,
sir. Please rejoin the queue.
Okay, I'll come back.
Thank
you.
Thank you. The next question is from the line of Shweta Padhi from SBI Securities. Please go ahead.
Hello, sir. Thank you for the opportunity. Congrats on the great set of numbers. So, in this quarter, we are seeing a slight increase in the GNP and the construction finance segment. Can you throw some light on that? And second question is on the cost to income ratio. The performance has been very good on the cost to income front. So, where do we expect this cost to income to settle by FY26 exit?
I think our cost to income ratio on the increased scale of operation, it should come down. However, we are going to add another 150-200 branches this year. So we expect this cost to income ratio to remain in the range of about 50% throughout the year. If we remove the impact of the addition of the branches, then cost of income ratio in real terms will be in the range of about 46 to 47%. But we assume that because of those branches, the impact will be there. So still, it will be much lower than the last year. And if we are able to do even the cost income ratio in the range of 50%, we are on the track to deliver ROA in the range of about 3.5%.
Yes, sir. And on the construction finance part, the slight increase in the GNPA.
So there is one account which has slipped into the NPA, and on account of that, the value of that account was 16 crore. 8 crore rupees provision have been provided for. But already for that account, as we do, if you see the last quarter, the recovery has also happened in this on account of one of the NPA, about 7 crore. This is constant phenomena. Further, there are a lot of developers who are coming forward to take over that account. So this remains on a consistent basis that whenever NPA happens, through the SARFAESI, other means you are able to attract the other developer to take over the account and recover amount.
Thank you, sir.
Thank you. Our next question is from the line of Chintan Shah from ICICI Securities. Please go ahead.
Thank you for the opportunity and congratulations on a great set of numbers. So just firstly on this, basically the asset quality, sir, as you mentioned, the GNPA is likely to be below 2% and NPA below 1.2%. So like given that some lenders have already flagged some risk on the MSME portfolio, so what gives us the confidence of how are we getting that confidence? And if you could just throw some light on the collections part as well, how the collections planning out. Yeah, that's the first question, please.
So, yes, as regards the collection is concerned, I think we have about 520 people, very strong team, and we have a very good analytics on the collection. The processes, automation is in place. We are able to track actively our collection agent performance and drive them. We have attractive incentive plan to push them higher. Having said that, yes, we have seen some of the slippages happening in MSME. We are more cautious for our incremental underwriting and taking the right measures. Currently, our collection efficiency in the range of about 97% upward in the segment. So we are quite confident that our focus will be to resolve the old NPA faster by doing a lot of settlement and other things. And we see that while our MSME is 100% collateralized, not like many other where they are giving unsecured business loan, they are collateralized where we have LTV cushion about 55% is LTV there. So with that cushion in place, even though the accounts slip into NPA, we are quite confident to auction those properties or recover back of those property by mutual negotiation and recover those amounts. Focus during the next 9 months will be that old NPA pool we are able to resolve faster by settling those accounts, by selling those properties faster. And I think with that pace coming back, our NPA overall will remain in range bound. As I said, our GNPA will not cross more than 2%. Our net NPA will not cross more than 1.25%. Within that framework will work.
Sure, that's quite helpful. And also, sir, secondly, on this AUM growth, so we have guided for around 30% AUM growth for FY26, but on a steady state basis, probably over the next 2-3 years, could we assume a similar trajectory, or are we looking to moderate the growth post 26? On the growth front, how should we look at it? Yeah.
So I would like to say that if you observe that we are a well diversified company in secured segment, we have currently 5 products. So we have ability to change the levers and increase one product which is doing better and reduce the other product which is doing not that well given the macro environment in some of the segment or some of the geography. With that capability in place, I think we are quite confident to achieve the 30% growth for next 3 years by targeting the AUM to be 50,000 crore by FY 2028 and maintaining our ROA at 3.5% upward. So with those two metrics in place, we are quite confident to continue on that path. And I think gold loan we have done well, where the yield is very good. Similarly, our retail construction finance segment is also doing quite well, giving the housing demand on rise and lot of traction we are seeing, RERA in place, security structures are good. Again, the housing loan remains a very high, very good growth driver. So with all combination of this, I think we are well placed to achieve a 30% growth for next 3 years.
Sure. And sir, just lastly, on the OpEx front, so I think our OpEx is relatively elevated, like around 6% or so. Do we see this moderating, like if the ROA is set to improve from here on? So what could be the key drivers? Other interest income, OpEx, or margins, or credit costs? Some thoughts on that, please. Thank you. That's the last question. Thank you.
If you see our cost income ratio, if you look at last quarter Q1 FY25, it was about 65%. Constantly by our gold loan branches delivering higher margins and skills, overall skill is also the AUM going up. The cost to income ratio have this quarter come below 50%. And as I said earlier, if overall basis, we intend to maintain our cost to income ratio in the range of about 50%. Given that we are going to add another 200 to 250 branches this year. Had not been that done, our cost to income ratio would have been in the range of about 47%.
Sure, sir. This is very helpful. Yeah. Thank you. And that's it from my side. And all the best for the future quarters. Thank you.
Thank you. Our next question is from the line of Sagar Shah from Spark Capital. Please go ahead.
First of all, congratulations, sir, for excellent set of numbers. I had around 3 questions. My first question was related to credit cost. This quarter, we saw the highest almost credit cost as compared to the last few quarters. And as you said, you had given the clarification that was regarding the one account in construction finance and some stress in MSME. So, looking the picture and looking like the Q2 will follow and will see a kind of a mirror to Q1. So, what kind of credit cost should we build in for the entire year, sir, for FY26 per se? That is my first question.
Thank you. So, I think overall basis, if you look at our credit cost, have been in the range of about 60 basis. And we don't see that much elevation. At the most, credit cost will not go beyond 70 basis. It is too early to say because we have seen the seasonality that every year Q1 is little higher. So this year will be slightly more higher than the previous average. But Q2 to Q4, between that, we see the remarkable recovery in terms of our old NPAs. And by that, we will be able to bring overall credit cost down. Even though on the conservative side, we said this year if the credit cost goes up by 10 basis, it will not cross more than 70 basis for an overall year basis. Okay,
fine, sir. My second question was related to our growth. Growth in this quarter was way above the industry average and one of the best quarters for you in terms of AUM growth. So even sequentially, the AUM has grown by almost more than 8%. So I wanted to understand which geographies are you exactly targeting? Is there any geographies that you are targeting that you are getting such a robust growth and that in such a period?
So I think we are going to add second half of the year Southern India market, which will be Tamil Nadu, Andhra, Karnataka, and Odisha also we are going to add as far as the gold loan is concerned. So these states we are good, Andhra, Telangana, Tamil Nadu, Karnataka, and Odisha. These are the 5 states we are going to add gradually, and we'll roll out the branches in the last quarter of this year.
Okay, so basically, is it fair to assume that this growth has been from the non-southern region, means in the western as well as the northern region?
Yes.
Okay. Thank you, sir. My last question was related to the gold lending area. co-lending AUM for this quarter was at around 19%. So going ahead for the entire year, how much percentage should we assume for the co-lending AUM and to be on books?
Co-lending AUM, we intend to project in the range of anything between 18 to 20% range, and this range only we intend to maintain this.
Okay, fine, sir. Thank you so much and all this for future questions.
Thank you. Our next question is from the line of Ashutosh from Ashika Stock Broking. Please go ahead.
Thank you, sir, for the opportunity and congratulations for good set of numbers. So, sir, I like to understand the fee income front. So currently we are approx 30% of our net revenue is coming from the fee income side of it. So what is our strategy going forward on this front?
So our fee income is mainly coming from co-lending, from car loan, and from insurance distribution. And our fee income, we intend to maintain in the range of about 25 to 27% throughout the year. One or quarter can be up and down by 2%, but overall yearly basis, our plan is to maintain it in that range.
And within these three segments which you have discussed, which is a major contributor and what are our strategy to take this?
Co-lending and also income from car loan and insurance.
Okay. Second question is on the cost of fund front. Like how much of our borrowing is liability is fixed versus floating, and how we see things moving forward from here on that front.
So I think next 12 months we are going to keep a major reliance on raising the commercial paper and NCD to meet some of our requirements, and those will be at a low cost. Our lending side, we are going to remain more on the now, given the few regulatory changes, we might shift some of the loan to the fixed basis because we see that interest rates are going to remain softer going forward.
Yeah.
So that will be our policy.
And MCLR benefit and all those, how much cost of fund benefit you are expecting in this whole year? From the current rate, do you expect it to come by 30-40 basis points for this whole year? Something like that?
So there are two elements to it. One is incremental borrowing. Incremental borrowing already started coming down by 20 to 25 basis. Hoping that we will get some rating upgrade. That will further go down by another 25 basis. Second point is that all the MCLR rates are getting reset on the due date of their 1 year or 6 month age the negotiations they have done during the time of drawing that loan. So in a phased manner, those banks MCLR rate reduction benefit will accrue. So on every quarter we'll see some benefit keep coming in. Overall basis, I think we should be able to get the benefit of MCLR reduction by 20 to 30 basis. This is depending on bank to bank.
Got it. And so on this cost to income, IT expenditure is also one of the area which we are focusing on. So can you give something like what we are doing, what type of expense you continue to incur in that area?
First quarter we spent about 26 crore rupees on various initiatives of the technology, data science, and now this year we are actively enhancing our team on the data science and generative AI side. We already deployed few tools on the AI transformation, which are going to drive the productivity and impacting the reducing our cost to income. So I think this the spend on the IT is going to be permanent feature. This is not going to be something that we'll achieve some milestone, it will come down. But this is a futuristic investment which will continue to do. We have currently about 200 people team in the technology, infra and data science.
Okay, got Got that, sir. And last question, geographical expansion. So any changes that in the opening of the new branches or something like that you want to highlight to investors on that front?
So I think we are going to, as I said, we are going to add 200 to 250 branches this year, combination of the gold, MSME, home loan, etc. And this pace will remain for next year. We are going to add about 700 to 800 branches. And that is important because when you have to plan 30% growth for the next year, you have to plan at least 6-9 months in advance.
These new branches will come in any new geography or our existing geography only?
So most of the new branches will come in the new geography. Some of the existing geography where we see the potential will increase, but majority expansion will happen southern India, as I said earlier.
Okay. Yeah. Okay. Thank you, sir.
Thank you. Our next question is from the line of Neenat Jadhav from LKP Securities. Please go ahead.
Yeah. Good afternoon, sir. Thank you for the opportunity. So my question is on the inside. So you have mentioned that the borrowing costs are expected to trend down by 40 to 50 basis points for this year. So how are we looking at yields front? Are we going to pass on the benefit to our customers as well? And if you could quantify how much yields are declined by this year?
So there I think we have to say that overall, if the interest rate goes down for everybody, that at least cost advantage benefit will get passed on to the customer because of the intense competition in the retail segment. However, whatever cost benefit and risk spread going down because of the our negotiation and also the rating potential upgrade, that benefit will be able to accrue to our P&L.
Okay. So any specific basis points it could go down by?
I think our current spread is in the range of about 7%. We intend to maintain that spread 7%. It can slightly be better because gold loan composition is slightly improving. So current composition, it will add another 3 to 4%, and which is a high yield product, and for which all the infrastructure cost and operational cost is already in place. So that is going to improve our overall spread. As regards the interest rate benefit which comes to because of the potential rating upgrade, that additional benefit will happen. As far as the MCLR rate reduction is concerned, because of the competition, that benefit, as I said, will get passed on to the customers.
Sure, sir. So my second question is on the recent announcement that we have made. So we have incorporated 2 new companies. One is financial service and another is wealth management company. So if you can tell us on how we are looking to scale these businesses, on what kind of customers we are looking to target, and with the cost for setting up these businesses will affect our cost to income guidance for this year or for next year as well?
There are 2 companies we have incorporated. One is going to carry out the investment banking activities only for the debt capital market, and another company is a securities company which is going to engage in the sales and distribution of the debt placement at institutional level, online bond platform and exchange trading. Both of these will not consume much capital, and they will be from the year 1. That will be accretive to the profit rather than taking any dent on the cost income side. On a full scale operation, we expect that this will also enhance our fee income. For that, by the end of the year, we will give the exact projection for the coming year. This year, it is in the setup mode. However, whatever the cost, they will be able to make that kind of money. So that will be cost neutral and no impact on the cost income side.
Sure, sir. And any probable customers we are looking to target, any set of customers?
Sorry, can you come again on the question? Probable set of customers for which segment?
For these companies which we have incorporated.
We have a team of about 10 people. We are going to add more people there. The team is specialized in understanding the need of the bond market, see the price trend, and we have large treasury book. Within that, we use those funds to buy the bond and do the buying and selling of the bond. Plus, we hold them for a short term, 15 to 30 days. We help the corporates to come out with the issuance of the bond as a merchant banker. So these are the fee-based activities we are going to do. These clients can be corporates, mid-size or the larger size, and it is similar to various bond issuance bankers. You would have observed that they are associated with such bond issuance. Further, this team will also help us to reduce our cost of fund because of their access to the capital market and their connect and understanding of the bond market.
Sure, sir. Thank you. That's it from us.
Thank you. Our next question is from the line of Darshil Javeri from
Hi, sir.
Yes,
Am I audible?
Yes.
Yeah. So, first of all, congratulations for a great set of numbers. Most of my questions have already been answered, so thanks to the previous participant. One question related to your business model. So, I mean, we are fully secured and have high-yielding book, but macroeconomic cycles, I mean, can pressure demand, collections, and risk appetite. So, how resilient are models across down cycles, especially in MSME and construction finance? I mean, where borrower cash flows can be volatile.
So construction finance, we are seeing that there are 2-3 important things have happened. One, that after RERA coming in, there is a designated construction account, there is a receivable account of the customer where all the money comes in. And we see it works is a very, very strong monitoring tool as well as the security structure. So having seen the good demand in the construction finance side, we don't see any such challenges. And even out of the 280 account, every year 1 or 2 account which slips into NPA for one or other reason, our team have shown the capability to find another developer, take over that account in the SARFAESI and recover the entire amount. So we are quite confident that even the risk-adjusted return with the low OPEX and the secure nature, backed by the strong cash flow of the sale of those apartments, we don't see any problem there. So we are quite confident, and this business we are doing since last almost 12 years. We have built a very niche, very good monitoring tools, and we don't see any surprises coming in that segment at all.
Okay, sir. And one last question. I mean, post this fundraise of 2,000 crores, how soon can we expect return ratios to normalize?
So, I will take this year, we are confident to deliver ROE in the range of about 13.5% to 14%. And ROA will not be less than 3.5%. Next year onwards, our strong fee income and coupled with our cost income ratio further coming down because now leverage of operating scale will kick in. So then our ROE will improve to about 4% and ROE should be in the range of about 16 to 17%.
Okay. So ROE 13 to 14 this year and 15 to 16% in FY27.
No, FY27 ROA will be about 4%. ROE will be in the range of about 16 to 17%.
16 to 17. Okay, sir. Thank you. All the best.
Thank you. Our next question is from the line of Somil Jain from Lucky. Please go ahead.
Hi, thank you for the opportunity, sir. Congratulations on good set of numbers. On the 30% AUM growth guidance, can you talk a little bit about what the mix will look like between the segments? Do you expect momentum in gold to continue and the softness in MSME to continue?
So We see that gold will continue to grow, even we are adding more branches in that segment because we see the strong traction and demand. And now our distribution team is all in place. So gold should be in the range of about 37 to 40% kind of thing. MSME will remain in the range of about 20-22%. Housing will remain in about 20-22%. Construction finance will remain in the range of about 17-18%.
Okay. Gold, you mentioned 37 to 40%.
Yes.
Okay. And secondly, on the branch addition guidance for this year, I think you mentioned 200 branches, right?
Yes. 200 to 250 branches will add this year.
Okay. And this will be any mix on gold or non-gold?
So I think gold will be in the range of about 100 branches, and rest will be between housing and MSME.
Okay. Okay. And finally, on the 16-17% ROE sort of expectation for next year, what is the credit cost that you've built in?
So credit cost on a long term, we are built in about 70 basis.
70 bits.
If you look at last few years, credit cost, except barring the COVID year, the credit cost has remained more or less in this range.
Mm-hmm. Right. And the quarter one OPEX, you mentioned will stabilize for the year because you're going to add more branches, correct?
So I think operating cost, keeping in mind our branch expansion, will be in the range of about 50%. Cost income ratio. Yeah.
Okay. Thank you, sir. That was it.
Thank you. Our next question is from the line of Lalit Kumar, an investor. Please go ahead. Hello.
Hello.
Yes, Lalit sir. Please go ahead.
Audible?
Yes, sir. You're audible. Please go ahead.
Good afternoon. Congratulations on your good set of numbers. My question was already answered. Thank you for previous participation. Thank you.
Your voice is not audible.
Hello.
Hello.
I'm audible.
Yes, sir. Now you're audible.
I'm saying that my question was already answered.
Okay,
Hello.
sir. Yes, sir. According to Lalit, sir, his question has already been answered. We'll move to the next question. The next question is from the line of Gaurav Purohit from Systematics. Please go ahead. It's a follow-up question. Please go ahead, Gaurav, sir.
Hi, sir. Thank you for allowing this follow-up. I just have one question on the micro-lab book. I understand it is a very new business, but in case there is a default in future, what is the legal recourse we have, given that the ticket size is around 10 lakh and not eligible for surface?
So the eligible recourse, ideally, the major effort is by negotiation. We make borrower to agree to come forward and sell his property or find his inner ecosystem to give him the money so that they don't, we need not to sell the property at much discounted rate. And another option is Section 138 to build the pressure and initiate the arbitration proceedings. And within that, these tools are effective. The combination of bilateral negotiation or using these Section 138 filing to build the pressure as we move to the arbitration to get the order and then sell the property and realize our money.
And what would be the typical timeline for this in your best assessment?
So, if we bilateral negotiation, you can yield the result case-to-case basis within less than a year. But cases which are not solved by bilateral negotiation, if we go for arbitration, then it takes a period of effective realization of money, anything between 2 to 2.5 years.
Got it, sir. Very clear. And last question I have on the competition intensity. So gold loan as sector is seeing phenomenal growth. Everyone is focusing on either growth or affordable housing. So what is the kind of intensity you are seeing here, given that, we have a steep target of going 30%? So just wanted your take on that.
So I think all the segments which are collateralized, but if you talk about competition, it is very intense competitive. Your right to win has to be how you use your technology, automation, and ability to turn around the sanction faster and do a better customer service in terms of how you handle them, how seamless your journey are, how less the paperwork you see without compromising on the asset quality. So I think amid the intensity, it is the turnaround time, it is the approach you take it, simplified approach to carry out the whole process makes a difference. The lending doesn't have a quality other than the service.
Fair enough, sir. Thank you so much for patiently answering all my questions.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to the management for closing comments. Over to you, sir.
Yeah, so I think I would like to say that our Q1 have set a solid tone for FY26. The addition of 2,000 crore capital raise give us the financial strength to accelerate the growth across lending and new verticals. Backed by a secured book, healthy asset quality and solid technology infrastructure, we remain on track to grow 30% annually and deliver sustainable ROE of between 16 to 18% ROA in a medium term to 4 and even growing up to 4.5%. There will be constant endeavor to bring our cost of fund down, and you will see by the end of the year there's significant reductions in the cost of fund. We will be quite conscious of bringing our operating costs in control by using technology and various other intervention of artificial intelligence. As regard asset quality, there are enhanced effort on the collection side and monetizing the NPAs, disposing of those repurchased assets to bring the overall net NPA in the check. So overall basis, we are on a quite good growth trajectory, and we are all thankful for the support shareholders and other stakeholders are offering to us. Thank you.
Thank you. On behalf of Go India Advisors, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.